Now, imagine if you are new to investing. Wouldn't it be great if there was a strategy that is simple and easy to follow? After initial setup, only needs an hour of your time every few months and stops you from overthinking and panicking when the market is going down. Well, there is one, and it's called dollar cost averaging, or in our case in Europe, euro cost averaging. Euro cost averaging is a simple investment strategy where you invest fixed amount of money regularly. The most common frequency is once a month or twice a month, just after you receive your salary. And the beauty of this strategy is that instead of trying to time the market, you stick to a consistent schedule, like investing 200 euros every month, no matter if the price is going up or down. You just do it every month and you don't actually think about it. I'll even show you examples in a spreadsheet so you can see some doomsday scenarios, what happens to your money if we have some sort of a recession, and how quickly you're able to recover if you follow this strategy. And by the way, I just wanted to mention that euro cost averaging is my favorite investing strategy, and I'm not telling you you should do the same. I just want to introduce it to you and tell you why I like it. Oh, by the way, I'm Robert and I'm glad you are interested in investing, and on this channel I talk about investing and personal finance from a European perspective. So here's why I love euro cost averaging as a strategy. It takes the guesswork out of the investing because you don't have to worry about predicting when market will go up or down. You just pick a date and the amount you want to invest, and no matter what, you buy the asset. Sometimes it'll cost you more, sometimes less. Another reason I love it is because it's reduced emotional decision making. It means no more panicking during market dips or hesitating during highs. Actually, after a few months, you will just forget that it even exists. Especially if you follow the tips that I'll give you at the end of this video, you'll just be so stress-free. It also reduces the risk of buying at the worst time. By spreading your investments over time, you avoid the risk of putting all your money into the market just before a crash. I know it sounds simple and obvious, but pretty much everybody who I know doesn't start with this strategy, or they don't start at all because they're too afraid. And those that do start, they usually just start investing in random stuff, lose some money, and then they say, hey, investing is not for me. But that's the thing. Those people were not investing, they were speculating and trying to make quick buck. Right now, I don't think you're completely convinced by the strategy. It sounds too simple, right? So let me simulate some worst case scenarios. Because one of my biggest fears when I started investing was, what if I invest today and the market crashes tomorrow? So let's take a look at that scenario in the spreadsheet. So for example, here I have S&P 500, and this is the last 5 years. And let's say we invested somewhere here at the end of 2022. As you can see, we had a quite big dip here, and only a couple years later, at the end of 2023, we came back. So that's just under 2 years we came back. I prepared this sheet for you. You can download it. It's the first link in the video description. And once you land here, don't forget to click on File and then make a copy. And this way, it just copies it to your Google account. And then you can start updating it. And the way it works is you have here the start date, and then you have the amount you're investing and the asset. In this case, this is a ticker for S&P 500. And it's specifically for the Google Finance. You can see here at INX, and that's the same one here. This way you can pull the data automatically, which is here. You have the start date, and then it pulls for this date, it pulls the S&P 500 price. Then we have the month-to-month difference. So for example, from this month to this month, the S&P 500 went up by almost 3%. And then we have the euro cost average that we're going to talk about mostly in this scenario. And then we have the bank account. And this is just a comparison scenario where we just take that money that we wanted to invest, and instead of investing, we just put it in our bank account. And I'm not taking into account any interest rate that the bank would pay. So if you want to add that, you could add to this scenario here. So let's take a look at this scenario. So first month, you're doing fine. You're up 3%. That's pretty good, actually. But then the things start getting really bad. So here, after 8 months, you are actually down, let's take this into account, by almost 19%. Not a good start, right? And then as you go by month 12, you're down by 15%. We had a huge drop here at 13. Let's say this is the worst case scenario. So 22% down just in the first 11 months. Not a good feeling. Obviously, if you look at what you have in your account, so here by month 11, instead of having 5,500, you actually just have 4,700. So it dropped quite a lot. Now, if we just calculate this, we see it's 22%, but here's the difference. Because you didn't buy everything at the once here at the beginning, it's not actually as bad of a drop. So not 22%, but you can calculate it quickly here. You dropped a little bit less here, percentage. It was actually 14% down. So your portfolio is actually down by 14% instead of the 22 because you're buying the stock every month and the price changes. The price you're buying changes. So you can, at the beginning here, you bought it for more. And then as things get worse, you're actually getting a discount and buying it for cheaper. In long run, dips are actually good because you get a discount on the price. Let's continue and let's take a look at the 2 years. We said about 2 years it takes to recover. So what do we have here? Here we are pretty much on par. You can see that this is 12,000 and this is 12,000. So we kind of recovered from that situation. Took 2 years, but we recovered. Where it gets interesting is because you're still in the market and you've been buying all this time and you have a bit of capital there, you start gaining quite a lot. So here by year 3, you are actually quite a lot up. So instead of 18,000, you have 23,000, which is 5,000 more. So what is that in percentage? 30% more by year 3. Making 30% in 3 years is pretty good actually, because I think the average that you can expect is about 8 to 9% per year from S&P 500. So this was really good result. But that's the thing, you just need to weather through it. Okay, you might say that scenario wasn't that bad even. You know, 2 years wasn't too bad. What about one of the worst financial crises we had in 2008? What if you started investing in that situation? Okay, let's say in mid-2008, that's when you start investing, and then everything just crashes. Let's take a look at that. So I come here, I change the date. Now, if you get this not applicable, just click on it. And then when you see in the formula, you have this -2 or +2, just change it to plus or +1. This happens because I think when the price is on the weekend or on a holiday, Google Finance doesn't give you the price, which is kind of annoying. So that's why you need to fix it. Okay, I fixed all those issues and let's take a look at this scenario. Since 2008, this was the worst time we ever had, at least in our lifetime. What happened then? Okay, month to month, you started investing, all is good, and then the crash happened. So we went down by 33%, huge dip. If we take into account just the first, 7 months, we're down by 50%. That's a lot. So instead of having 3,500, you actually have 2,700. Again, we are not down by 50% because we are euro cost averaging. So when I calculate this, actually the drop was 20% instead of 50%. So imagine putting a 10,000 at this point, you would actually have only 5,000 left. So this is why I love this strategy. Even if there's the worst time ever, we still can recover from this. It takes a bit of time, but you'll be able to recover from this. If I look at the first year, we can see here 22% down. But actually, you see here, you are above that bank account. So you actually have more money now than if you just put it in bank account. This was the worst crash we ever had. And yet you are up by 6%. And again, this just happens because you're buying it at the discount. Every month you're just buying it. So let's take a look what happens after 2 years. Here, month 24. Oh, we're actually a little bit above the 12,000. So you see here, instead of having 12,000, we have 13,200. And that's 10% increase compared to the bank account. But then by year, what is this? 36. By year 3, we are already up by 20%. So instead of having 18,000, we have to almost 22,000. So you can see, even in the worst case scenarios, you are able to recover quite quickly, and then you start growing your portfolio. As you can see, with euro cost averaging, you'll still keep buying every month, even if the prices go down. And actually, you'll be buying the asset at the discount. And hey, if you haven't heard, I actually have a newsletter sharing my thoughts about investing and personal finance from a European perspective. If you want to receive the weekly newsletter, just sign up. The link is in the video description down below. Another objection that I kind of used to have is that we are already at the top. It feels safer to me to wait until it goes down and then I get to buy it. Now, obviously, if you could predict accurately when the market goes down and how long it stays down, that would be the greatest strategy ever. But in reality, nobody knows at what point it will start going down, not even the experts. Okay, my light just died, but I think I can continue with like this. Besides, waiting on the sidelines means you're missing out on potential growth right now. Let me show you what I mean. Okay, I've been talking mostly about the worst case scenarios. What about if you could time the market and actually for a few years you have a really good time? So let's say somewhere here in this scenario from here, from 2011, end of it, maybe November, and then forwards. Let's take a look at what happens. So I already have the dates here, same amount. Let's see. First year, we are up by 5% almost. So instead of having 6,000, we have 6,300. Not a big deal, right? This is a little bit below what we would expect on average, but that's okay. Then we continue. Year two, we are up by 21%. Okay, well, that's actually, that sounds much better. 10% per year. I would be really happy with this results. And then year four, we are up by 24%. So apparently in 2013 wasn't that good year, but we are up by 24%. And we could go on with this one, right? I could just take this and extend it as far as today, and then we can see how much it would grow. So I've extended the formulas, and now we have almost 10 years. If I scroll down to year 120, after 10 years, we're doubled our money. You can see if you didn't invest, you would have 60,000 in your account after 10 years. But if you did invest, you have 124,000. And I hope these scenarios help you understand how it works and why I like this strategy so much. Personally, I have very low risk tolerance, and these types of scenarios calm me down in some ways because I can play around with it. But there are 3 tips you need to know about euro cost averaging that I learned the hard way. Now, the first tip, it might not be that obvious, but if you're trying to buy a stock or ETF every month yourself, it's really unreliable. I started this way and I was inconsistent. I missed some months because I started overthinking. Hey, oh boy, we're at the all-time highs. I'm not gonna buy now. I'm just gonna wait for another dip. And I skipped a month here and there, and it just wasn't consistent. That's why you should automate it. And many investment brokers offer recurring investment feature. And this just you set it once and then it will just invest for you automatically. And you send from your bank account, you send money to the broker, and then the broker will invest it. So it's so easy once you implement. The second tip is to start paying your investment account before your bills. Obviously, if it's possible, you cannot not pay your bills. But let's say you get your salary on 24th, set an automatic transfer of money to your investment account a day or 2 after your salary. And this is crazy stuff, but if you do this, you will quickly adjust your spendings to the remainder of the salary. So if part of it just goes to investments, the rest you spend the way you want it, but at least you know that some of it is already saved. And I'm telling you, it's just amazing how we humans can adjust so easily. Just give it a go for a few months and you'll notice. The third tip is that you can't expect miracles from this strategy. It is an excellent strategy for long-term investing. We are talking about 10 plus years, at least. If you want to make a quick cash today, it's not for you. But trust me, 10 years will go fast, and imagine having 10, 50 or 100,000 euros extra just from your investments in 10 years. Now the thing, before you can start euro cost averaging, you need an investment broker that offers automatic investing. That's why you should watch this video right here, where I'll compare 5 popular investment brokers and tell you my favorite ones, because I've used all of them throughout my 7 years in investment journey.